What's up, everybody? Michael Silva here. We're halfway to a recession, and we got some critical charts to go over today from a weekly perspective and monthly perspective because, well, the week just recently ended and, well, the month just recently ended. Now, we're looking at the 10 and 2 and the 30 and 5, so why am I saying that we're halfway to a recession? Well, we got the yield curve inversions, and the next big piece of data that came out was that the GDP, US GDP, fell at a 1.4% pace to start the year as pandemic recovery took a hit. Now, as most of us know, often a recession is defined as 2 quarters of negative growth. So halfway there. Now, we do have a big week ahead of us. The Fed is set to raise rates by 50 basis points on the May 3rd and 4th meeting and is reported to do so again in June. How's the market going to respond? Well, I mean, the market's been responding with a lot of volatility. Here's the Fed Watch tool, and you can see there is a 97.1% chance that we will be right at around 75 to 100 basis points after that meeting. Now, you can look at all of this data and just dig into it and understand the economics of all of it and so forth, right? But to really simplify things, that's why I love to look at charts, because charts tell a very big picture. And, I want to point this post out here specifically. This is one that I post on LinkedIn. I rarely post on LinkedIn, and if I do post there, it's something that I find to be very, very valuable in a short snippet. So I'm pointing this out before we get into our main chart deck, but every stock market signal I looked at, and this was back in July heading into August, was flashing warning signs. Okay, the divergences, they've been building for months, and small cap stocks are about to break major support. You wouldn't notice this on most cases because the Dow, the Nasdaq, the S&P 500, they were all near all-time highs. But if you peek behind the curtain, there's oodles of deterioration. We show that in so many different videos and so many of these big divergences building. And people kept on saying, this time is different, it's different, it doesn't matter anymore, right? And then I wrote, I wouldn't be surprised if in the coming months we get a big news event. It seems like the bond market has been pricing it in since May. And well, if you just look at what the bond market was doing in May, how the yields were heading down, there was some significant shifts in the market taking place. And since that point, well, we've been seeing just clear, huge amounts of volatility, and we've been getting some big news events. So now I'm going to be showing you some bigger term charts to give you an idea of what price action is doing and how the market is kind of forward looking and what we can expect going forward. If you're new here to the channel, welcome. Consider hitting that thumbs up button for me. It's greatly appreciated. And subscribing to the channel. This is the Stock Market Brief Show. We use technical analysis and intramarket analysis to get a good idea as to where the market might be headed next. Let's go ahead and get into today's episode. Alrighty, everybody, welcome back. We're going to start here looking at some weekly charts. This is the Nasdaq Composite. It has now fallen 4 consecutive weeks, totaling 13.2% down for the month. This is its worst decline since October of 2008. And you had declining stocks really outpace the advancing stocks by almost 2 to 1, or I think it was actually 3 to 1, which is a big move to the downside. Okay, and I'm pointing this chart out specifically because I want to just call out a couple of indicators here that you're going to notice. First and foremost, we're below all these key moving averages. I'm talking the 30-week, 40-week, 10, and the 5. Okay, so will we see some sort of technical bounce here? Well, we'll talk about that in the stock market indicator section. The PMO, it is pointing straight down. It is below 0. We're cracking back down beneath this trend line. Okay, and we saw some decent volume too on this break. This does not look good by any means. So the trend still is high, lower high, lower high, a low, a lower low, a lower low, and now we just got another lower low. So the trend is clearly down at this point. Volatility has been elevated. So what does this mean for market participants? It means to be guarded, to be defensive, and the market has been telling us to be defensive for quite some time now. Now, when volatility reaches high levels, everything and anything can get hit. Okay, so that's the NASDAQ composite. If you look at the SPY broke this trend line here too as well. Big move to the downside, down 3.3% on the week. And we clearly have wind at our face as the indicator, as noticed by the PMO, price momentum oscillator, as well as the RSI. Here's below 50, and this one's still pointing pretty much straight down. So if you go long, it has to be tactical because you still have wind blowing at your face at this particular point in time. The Qs, tech growth stocks, even big, huge mutual funds, okay, very successful growth mutual funds are down 20 to 30% year to date. So it has been a very, very big hit, but Qs down 3.73% on the week. And this really came from on Friday's big sell-off, right? The week was looking pretty good on Thursday, and then all of a sudden, volatility stepped in, sellers hit it really hard. This came also on some bigger volume. RSI is clearly pointing straight down, well below 50, and we still have also wind at our face here with the price momentum oscillator. The Dow Jones Industrial Average, price momentum oscillator, it's been diverging, still pointing down. RSI still pointing down. And, I'm going to zoom into this part right here so you can really clearly see of how kind of like the market is picking up momentum to the downside. But we'll get into that here momentarily. Another one is the Wilshire 5000. This is a great view of pretty much all the stocks in the U.S. market here. And you can see we had resistance, resistance, resistance. It acted as support, and we still actually haven't tested this trend line. And we saw 4 consecutive weeks, obviously, to the downside here with wind at our face. RSI is below that level. So I think that it's possible that, hey, the market, if this reaches down further, we might see some sort of a bounce. But if this starts breaking and giving way, which it looks like it's doing, in a stage 3 distribution right here, there could be some further downside. So we need to be very mindful of that as the trend has been breaking. The IWM, small caps, right? We went into a period of distribution for quite some time, and now this looks like a stage 4 decline, a start, and somewhat of an early start, I'd say, to it. And 165, 170, it looks in reach. I don't think it's going to go straight down there by any means, but I think that it is definitely in reach as we've never really tested these prior areas of resistance, and we have a gap right here. This right here is a bear flag. We broke down it. I think that it's more than possible that we start seeing some rallies in the near future, but be mindful that, hey, we have a high, lower high, lower high. We have a low, and we have a lower low. So the trend still, once again, remains down. So you need to be protective. Protect your capital. Okay, let's continue on. And I want to zoom in here. So the SPY, you can see a little bit closer in, right? We have some the drop-off is happening on some inclining volume. We had a pretty big break. The lowest weekly close here in 2022, as you can see, we're closed at 412 on the dot. Okay, so yeah, below all these key moving averages, it doesn't look good. At some point, right, typically if you get 4 down weeks straight in a row, we'll probably likely see a rally. Be mindful that it could be a bear market rally. Why? Why do I say that? Well, do you remember this rally right here where everyone was like, oh, the market's in, we're at max, bearishness, pessimism, everything. It's time to go, go all in basically. And we saw this rally and it got reverted in a very quick, short period of time, and we're already breaking down through those lows. Okay, so be mindful that you will see some big, huge rips. That's for sure, but that does not mean by any means that the trend is all of a sudden changed from bearish to back to bullish. The Qs, you can see here, big volume, big volume break of this area. Is there more downside to come? Hey, it's more than possible, but after 4 weeks of straight, basically closing at the low of the week each trading session, there'll probably be some bounce here in the near future. I wouldn't be shorting at this particular point in time, given just where we currently stand, but this is definitely a sell the rip environment. So if you are tactically playing for a bounce, once again, be very mindful and be very tactical, meaning that you need to take profits. And when we come up to prior resistances, guess what? That means you can sell those rips. Okay, here's the Dow Jones Industrial Average and what I wanted to talk about, kind of, momentum building. So first and foremost, we saw this big move to the upside, and then take a look at just the bodies of 1 week, 2 week, 3 week, 4 week, and then 5 week. Okay, what you'll notice here is the candle starts off very small, then gets a little bit bigger, and then it gets a little bit bigger, and then it gets a little bit bigger, and then it goes kaploom. Okay, so you can see that the body, right, the body is starting to build momentum to the downside. So this right here shows me that there's more fear stepping into the market just from a price action perspective. If you see those bodies getting larger, right? Usually, if you start getting to a bottom, you'd want to start seeing the bodies getting smaller, and that would indicate that, hey, you know, a little bit of indecision is taking place. Very similar to how we saw this big move to the upside, and we saw this little body, right? Big authoritative candle, but then a small one. It let us know, okay, is this run kind of taking a little bit of a breather here? Which then says, okay, if we start getting and closing above the high of this week, then ignore that. But if we start closing below, watch out. And as you know, we came into those moving averages, and now we're starting picking up steam to the downside. A lot of this doesn't, to me, look quite like capitulation at this time, especially when I took a look at the daily charts, which we're not going to be digging too deep into. Look for Monday's video where I'm going to get into the risk ranges a little bit bigger, okay, to prepare you for all of that. But yes, just pay attention to kind of the momentum of selling that's taking place right there. Okay, now let's hop into some monthly candles to get a good idea as to what's going on. So first and foremost, transport's incredibly important to watch what transports is doing. We had this blow-off type candle right over here a few months back. PPO is crossing over, and we've been at this negative divergence. We're above that 20-month moving average, okay, and we're below the 5-month moving average, but we've really just been kind of sideways. So if this starts giving way, that opens the door for transports to hit that lower Bollinger Band and prior areas of resistance, which can very well become support. And that's a pretty significant move. We're talking from around 15,000 down to just like 11,500. So that'd be a big news event to drive that down to those levels. If we take a look at the BKX, this is an interesting chart on the monthly time frame, because when we come up into this red zone, I talked about this chart many times. If you've been around, you've seen it. The red zone, every time we get into these areas, something always bad happened. And it was like the 2008 financial crisis. We had the repo fiasco. We have over here the pandemic. And now what do we got going on? We got Fed tightening going on over here. And you can see we had this breakout, but clearly the month was down 11.34%. If you don't know what the BKX is, that's the largest 24 institutions. We had these high wave candles right over here indicating that the momentum could very well stall out. And now we're starting to see that aggressiveness sell off here, getting back within underneath this prior area of resistance. So it was somewhat of a bull trap right here. So, and then on top of all of that, we had the PPO and the RSI, right? So PPO is crossing over to bearish. RSI is pointing straight down and crossing below 50. This is a very aggressive move, so I can imagine it coming back up, trying to get some more people. But if you look at the bigger range, the bigger time frame, I mean, this is setting itself up to just obviously head lower here and working it head. I mean, we'll see. We'll have to look, you know, on some other charts here in the near future, but it just doesn't look good overall. And we know how incredibly important financials are to the market. Now, when I zoom out really big and you think, okay, well, there's been a lot of selling, like you really got to take a big look at these charts. Like, for example, semiconductors, it makes up a big portion of the NASDAQ composite. And when you really zoom out like multiple years, I mean, we're looking back to 2002, they haven't even really gotten hit yet, right? So, you know, if you think that there's going to be some crazy stock market crash or the world's going to fall apart, I mean, or feeling as if it already has. I mean, look at the market. I mean, it's, you know, it was a big month down, 14.8%, but just look at how far this thing has come. But not even to mention way back when, if you just look how far it came from the pandemic. All right, the pandemic went from, you know, a high of around 160 and it shot down to just under $100, but it came pretty much straight up. And we're seeing a lot of stocks, individual equities, start to take out their pandemic lows. I'm talking PayPal just recently matched its pandemic low. We see, I'm not going to get into all the different stocks individually, but there are many stocks that are testing their pandemic lows or testing their pre-pandemic highs, or right in kind of this middle of the range, like, for example, ARC, right? And semiconductors make a big portion of the composite, and we're starting to see, obviously, periods of distribution. And if semiconductors get hit down to 140, we're talking NVIDIA, AMD, the big names here, that's going to put a lot of pressure on, continued pressure on growth stocks, okay? So this does not look healthy. It does not look good. If the semiconductor ETF wants to continue to head down on a monthly basis, I'd be looking at that lower Bollinger Band, but we're going to have to keep on paying attention to that as months progress. Another couple of things I want to share is the DJW. This is the Dow Jones Global Index. Now, if you don't follow me on Twitter, these are updated charts from when we started breaking out of the channel. And the reason why I'm showing you these is simply because let me get that out of the way, is because they look like exhaustion breaks of bull channels. So as you can see, resistance, 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 support, 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 exhaustion break. And then when we started breaking out of here, very similar to the IWM, I was saying, okay, these kind of look like they could be exhaustion breaks as we're having negative divergences. RSI was kind of pointing down here. And you can see that we're breaking down pretty significantly. The Dow Jones Global Index was down 8%. And the RSI is getting back below that 50. We had that bearish crossover on the PPO. So this to me says that we can come test the middle of the channel, which is probably around 475, maybe a little bit lower, or potentially even the lower Bollinger Band, or even the lower channel again. I mean, it's all possible. Just realize what's taking place on these charts. It's not healthy by any means. And if you look at the SPY and you look at this zoomed way out on the monthly time frame, I mean, just look at here. I mean, we're seeing volatility, and it was down 8.78% on the month, which is a huge down month for the month of April. And we barely even gotten hit. And you can compare this. I mean, yeah, you can look at these big crashes over here that took place. The dot-com bust, the financial crisis. This right here was the pandemic. And look at how far we are off from even testing the pandemic high right over here. And you're seeing a lot of equities break down to those levels. So can this thing come down lower to like 375? I mean, it's all very possible. And do you think the Fed is going to be like, okay, now we're going to put in the Fed put? I don't know, especially with how inflation is kind of taking place right now. So just be mindful once again that we haven't even really gotten hit hard yet, but yet things are really falling apart, and we haven't even really started to see capitulation. And by capitulation on the monthly time frame, I mean, this was a big month down, okay? But look at the volume bar. I mean, the volume bar was like nothing, okay? So it was almost nothing. So this thing can turn back around. I'm not saying that it can't. I mean, for all we know, like David Hunter is going to be right, and this thing is going to fire off to 500 here soon. But just be mindful that, yeah, we're seeing massive volatility, but we haven't even seen like capitulatory type volume like we saw here in the pandemic, or even the financial crisis, or even here in 2011. Okay, so that is something that we want to pay very close attention to. The Qs also, big down month, down 13.6%. As we've already stated, but the volume wasn't capitulatory. So it to me, if that's even a word, capitulatory. But we do have that bearish crossover, which means even on these longer term time frames, the monthly, the weekly, you have wind at your face by going long here. So you got to be tactical. Okay, so this is all about protecting capital right now. If you look at the IWM on the monthly time frame, this was one of the charts I posted on Twitter back when this started breaking out on big volume. I said this has all the markings of an exhaustion break. Now, it took over a year to start coming back within the channel, but it to me seemed like it would be doing so. So I'm not too surprised, but we are still even seeing that continued weakness here, where it definitely looks like it could potentially test, like we said, that 170 level at some point. I don't know when exactly, but we have wind at our face here looking at the PMO, and RSI is below 50 pointing straight down too. So we have wind at our face. The bulls have wind at their face. The bears, they've gripped a hold of the market. So be mindful of that. Now, on a more positive note, if you take a look at something like gold on the monthly time frame, this looks like it's about to have a bullish crossover. Gold was down 2.6% on the month, so it outperformed and is delivering alpha. I mean, if you need to be invested in something, I mean, the dollar, cash, right, or even gold at this point is looking good. I don't have a chart of silver up. Silver was looking absolutely amazing. It broke out of this nice wedge, okay, and it started breaking out. But unfortunately, like if you played that, you had to make sure you had these stop losses in place, because silver, it broke trend and started heading right back down. There may be opportunity there, but as it stands right now in this current environment, gold is the one that's holding up. So gold is the one that you should focus on. Even surprisingly enough, this monthly candle, so the prior month, this shooting star candle, it was starting to break down, and that would not look good if we had a monthly close there. But look at where we closed. We closed pretty much matching, open to matching close right here on these candles, holding that 5 EMA on the monthly time frame, which is actually a positive sign here so far for gold. So can it still break down? Obviously, but as it stands right now, still holding up. So this is going to be an asset to watch for sure this quarter, and also going into next quarter. Now, if we look at month to date, what took place in the 11 sectors that made up the S&P 500. I just want to point out what's performing the top. Well, consumer staples, once again, defensive sector, it was up 2.13%. But as volatility rises, all these things are going to get hit, right? I have positions in consumer staple products, more in the food beverage area. And I also have newer type positions, I should say, also in utilities. And utilities got hit 3.16%, mainly getting the big hit was on Friday's trading session. It was down around 3%. Not the biggest positions, but I'm personally positioned more defensive given the current market environment, but I will trade intraday on occasion some bounces within some of these other names. Now let's just go ahead and hop into Bitcoin. Now I posted this chart on Twitter. It's kind of a joke, but kind of not. All I'm doing is doing a full measured move of a bear flag. So what does that mean? It means that I'm measuring the high over here to the low, right? That's the pull. Here's the bear flag. This is the monthly time frame. And that right there would bring a full measured move to 2250. Now I've seen crazier things happen. And, I know that no one's going to believe that this can happen. But just be mindful. There's a couple of interesting things taking place here on the monthly time frame. First and foremost, we have wind at our face. Okay, looking at the PMO, bearish crossover. The trend, it's being tested right now. We also have that bear flag. Okay, and then on top of all of that, what you can watch for is the volume profile. All right, the volume profile has been very beneficial for Bitcoin, right? So price of Bitcoin goes up, volume's been rising, right? Bitcoin falling, it's kind of more even, right? It's been rising. And then on this downfall, right, look at here, volume is declining. We start picking back up, volume starts picking back up. We start going down, volume starts going down. We start picking back up, volume starts picking up. Now what we're doing is consolidating here. So this is neither bearish nor bullish at this particular point in time. What I want you to pay close attention to is what happens next. If we get a break and all of a sudden now volume's picking up, that is now a bearish thing taking place in the volume profile. As it stands now, we are in a bullish trend, looking very bullish on this long-term time frame. But if we start breaking down from trend, if we start cracking down through really 30,000, and all of a sudden volume just starts taking off like crazy on moves down, that's going to be pretty significant, and it could show us a very significant break in trend that we need to be very mindful of. So this is like worst case scenario, all right? But from a bullish case scenario, let's just call it what it is. Hey, you have a big pennant here, and this could very well be potentially flagging. I've looked at quarterly charts, and if this is a bull flag, right, so we move up on high volume, now it's consolidating on lighter volume. If this thing takes off, we're talking, it can definitely reach a lot, those targets of what everyone's been saying about 100K plus. So that's also from the bullish aspect of it. But be mindful of this. There's another thing I want to call out. See this right here? This was a trend break. But guess who stepped in? Starts with 3 letters. The Fed. So the Fed stepped in, did unlimited QE, and we already know the correlation between Bitcoin and tech stocks and growth stocks. There's a very high correlation. A lot of people don't want to believe it, but that's the truth. There is a high correlation, and you can use the COR indicator to see that, visually see that. Okay, but now we're testing this trend, and guess what the Fed is doing? The Fed is going goodbye. All right, so if we start breaking, will the Fed pivot, or will potentially Bitcoin uncorrelate itself from high-risk assets, high-growth assets, tech assets, whatever, and then start, doing something different? If that happens, that could be very beneficial for Bitcoin. But as it stands right now, we're on the edge of glory, as Lady Gaga would say. Now, another couple bearish things here, unfortunately. Still on that sell signal, and it looks like it's about to start breaking down from this bearish area. But, 4 weeks straight down, the market's looking a little overextended. We'll get into those signal indicators. We can see a bounce, but let's hop into the daily time frames for Bitcoin. All right, we are over here on the FTX.US website, the ones that sponsor these shows and support my channel. It is greatly appreciated. If you don't have an account with FTX.US, you can sign up with the link below. You can use code TRADERMIKE if you do the app. I like to use the website, just FTX.US. I have a link in the description below. Let's take a look at the daily time frame here of what's going on. First and foremost, doesn't look too healthy, right? It's been throwing us back and forth just like the market has. started looking good, tagged that 50-day moving average. In the grand scheme of things here, okay, in the grand scheme of what's going on, it's really just going sideways. Now, I will say that these couple of moves to the upside, these two candles right here, let's zoom in here. Pa-bam. Okay. These 2 days, those candles actually happened on inclining volume, which is positive to see. So that could be an indication that, hey, you know, these down days right here on less volume, significantly less, maybe big volume could step in on a break, but as it stands right now, we're still holding up quite well this 38,000 level. So if 38,000 really does start to give way, if we start clearing, basically if we start breaking below the low of this candle, that does, which is, let me see here, that's 37,692 basically. We'll just call it 37,700. If it starts really giving way there, that could definitely spell more downside. We just got to really pay attention to what's taking place with the volume. But if we also zoom out, you can see that, you know, if I just look at, it's been holding support in this area, support. And looks like we potentially back tested it, and it actually held now as resistance. So, you know, it's difficult to say as it stands right now. Unfortunately, we're still on that sell signal. If you trade this intraday, you know, there's probably, you know, great opportunities, but from the daily time frame, still has some pressure to the downside. The trend remains down. If we take a look at Ethereum, let's take a look there. Ethereum, it's kind of on that brink too as well. So if I zoom in, you can see here, we've been trading 1, 2, 3, 4, 5, 6 trading days pretty much sideways, even more than that if I break it out, but 27.70, if it starts giving way and we start seeing volume pick up, that could be a pretty nasty sign. You can see here volume's been drying up, and we sometimes see a lot of volume step in on the weekends, especially on big breaks. We'll see here if that's actually the case. We did see that bear flag breakdown. It's still kind of just doodling around. If you just take a look to the left of the screen, we're over here, right? So, you know, zoom out. It's, yeah, I mean, this could still be very similar to, you know, Bitcoin, where it's kind of presenting itself like a bull flag, or bear flag, sorry. And this is the early stages of a potential break. It'd be great to see this thing turn around, but if it, you know, I would imagine if this starts turning around, I would imagine to see the equity markets turn around too. So let's now go ahead and hop into some stock market indicator charts to find out what's really going on here. All right, so we are looking at the VIX Volatility Index. So first and foremost, VIX fired out, it's still above 30, which means what? If it's above this 30 range or in this 40 range or even higher, you're going to get tossed around. You're going to get chopped up. It's a very dangerous environment to be. If you're a tactical intraday trader, you know it's a great opportunity to start trading intraday, especially if you know how to tactically do that. But for swing traders, it just makes it miserable, right? Breakouts fail, breakdowns. You know, you'll get it's just a bad environment. A lot of short setups typically set up in these environments, which I'm starting to see actually in like cyclical stocks. So first and foremost, we have that negative divergence on the VIX, okay? We have a gap above us. It actually started filling the gap a little bit. So this could act as a potential area where we might start seeing an eventual bounce here in the near future. Now, what I find interesting is the market 4 weeks straight down, right? You typically, what I've seen in the past, you get some sort of a bounce. And I looked at some data, I don't have it with me, that you get some sort of a bounce or relief rally coming in the following week. So we'll see if that's the case, but looking at the VIX, right, having a negative divergence, and we're pretty darn frothy right now, right? We didn't take out this previous high, which is interesting, and I know that we were in backwardation. I haven't checked recently, probably still are. Okay, but then also we have a gap above us at around 45, and if we get up to gap 45, I would definitely be adding into my longer term portfolios. I would just be buying that dip regardless, because that to me it's more of a rare occurrence. And even if the market were to continue to head lower, it doesn't really bother me at that particular point in time. So 45 on the VIX is a level that I'm paying very close attention to. But okay, let's continue on and look at some of these indicators. These are the percent of stocks above the 50-day moving average and the 200-day moving average. I just wanted to call out here, we're at 27.66 and 37.07. If we look to the left of the screen, right, we're right here. You can see that, well, we're not there all too frequently, which tells me a lot of stocks are obviously getting beaten up, but we're getting a little overextended to the downside where we've seen bounces occur. Okay, and you can see here the 25 reading, it was right around this area, and we saw those bounces, the bear market rallies occur, which, by the way, it would be a bear market rally until proven innocent. All right, NASDAQ 100, Okay, this is percent above the 50-day and percent above the 200-day, a 19 reading and a 20 reading. So you can see here, these are some of the deterioration charts that I was watching while the market was going up. Market was going up, and all this stuff was just deteriorating, just letting us know, okay, something's going on here. But yeah, we're below that 20, or we're at 20, and we're below 20 here. That's also getting overextended to the downside, which tells me it's setting itself up for a tactical bounce to the upside, okay? And we saw how powerful that was on Thursday. Here's more stuff that's interesting. The Bulls and Bears survey, this is a very, very, very bearish reading with very, very bearish sentiment. Haven't seen this for quite some time. Actually, if you really zoom out, you start looking at like 2008, this is like, so one, this typically can mark somewhat of bottoms. Now, these are just surveys, okay? So take that with a grain of salt. All right, contrarian indicators, typically when things are really bearish, that's when you want to start looking bullish. Looking at price action, it tells a little bit different of a story, but if you look back to like 2007, 2008, when you look at these charts like this, these indications that were this more bearish sentiment, as you can see, these spikes down, is the start of more bearish activity to potentially come. Okay, and that's kind of what it showed in 2008. I'd have to bring that chart back though, I don't have it with me. Okay, and if we look at the asset managers and then the Ridex, you can see here it's getting pretty bearish as bearishness continued these last 4 weeks, as we've already known. And then also we're back below that 50 reading. And typically when we're below 50, that typically sometimes marks bottoms as well. As you can see over here, we started finding that bottom, but it can get very treacherous. Obviously, it can get, into the 20s, into the 30s down here, which mark these bottoms over here. All right, so interesting data, but obviously what I'm trying to get at here is sentiment, very bearish, as you can probably tell. Okay, now advanced decline line. We talked about this when it was overextended at minus 2250, and we got that huge squeeze. It was a huge squeeze, and then guess what? It got completely reverted, right? That Morningstar pattern did not follow through. That happens, okay? But what I want to call out here is we're back down to that minus 2,000 reading with a positive divergence. We have a new low, all right? But we have this reading putting in a high, which tells me that, hey, very well can bounce up to, so be very careful of that, or look for a short covering rally coming into Monday, maybe Tuesday. All right. The risk ranges, by the way, which I'm not going over on this video, they're huge. They're gigantic. Okay. So that tells me volatility is going to continue. Let's look at some bottom indicators right now. This is the NASDAQ record high percent index. This is a great indicator for when it gets below 20 and then crosses back above that 35 reading. This is something that I learned from Stock Charts, David Knipner. He posts that chart, and as you can see here, we are back in this minus 20 reading. So we got to wait for it to cross back above 35, and that can, signal some nice starts to some moves. It actually signaled the, bottom of the 2000.com bust. It signaled really almost the bottom of the 2008 financial crisis. And hey, now we're into something new. Maybe when this crosses back above 35, this is that indicator telling us, okay, let's feel more confident and start putting money to work. Another one here is the Cohen High Low Index. When it gets a 0.05 reading, that marks bottoms. This looked like it did it, but it got actually 0.06. I remember watching it. You can see here, it found the COVID pandemic bottom. It found right here in 2018 bottom. Here, the 2008 financial crisis, it tossed us around quite a bit, but it did end up eventually finding that market bottom. It also found that .com bottom there too as well, and also found the bottom of when long-term capital management blew up. So this also is a very powerful indicator that, I want to pay attention to. If we take a look at the CPC, I use this as the buy and sell signal. I want to just call out that the 10-period moving average continues to trek upwards. This is pretty bearish type activity as we've seen previously. When it was at this level, you look back to the left of the screen, we did see a nice big bounce, but then we started seeing increased volatility driving that marketplace significantly down, and then it wasn't until we started getting back to this green line that started marking the bottom. Okay, so yeah, not looking all too hot overall. All right, but hey, stay positive. Things can change. Another thing to pay attention to is the summation index, right? We talk about this. Nothing really good happens when it's trending below zero, and guess what? It's still trending below zero, still pointing straight down. Do have a little bit of a positive divergence there on the Nyes-McClellan oscillator. So that is, the NIMOT. Something to pay attention to. And then a couple of other charts here is the BP charts. Look at getting overextended also. This is where breakdowns can occur, but also we have a little positive divergence building on the BP SPX chart, which tells me once again, This isn't the area that you want to short. This is actually potentially an area where you want to start tactically looking to play long. And just be very careful, right? BPNDX also not too far off that overextended area, but it did get worked out on Thursday. And then we have the NASDAQ Composite Bullish Percent Index, an important one to watch. This one is it's getting overextended, and we're seeing obviously, 4 weeks straight down, a month that was down 13.2%. Looks like it can potentially set itself up for some sort of a bounce here in the very near future. So be prepared and be mindful of that. And also, get ready to sell those rips, because this could just be the beginnings of something a lot bigger. Remember, we're halfway there to a recession. All right, everybody, that's all I got for you. It was an action-packed episode. Hope that helps out.